For a long time now, I've been fairly neutral on investing in China. It hasn't been something that I wanted to go long, also hasn't been something that I wanted to short. Some of the reasons for this is because China has some good long-term growth potential, but also has some big short-term risks that we've seen unfold really over the last year. However, as of right now, that trend might be reversing. Deep value investors like Charlie Munger, who have long, successful track records of investing, have been buying the dip. And I started to slowly nibble into exposure to Chinese markets as well. And in this video, I'm going to explain why. Ready? Let's dive in. This video is sponsored by Lithium Chile, but more on that later. China has been in an extreme bear market for just about 1 year now. We're going to take a look at some charts of the major Chinese companies. First, we're looking at Alibaba here. You can see very clearly a giant drop from the top. Same thing with Tencent. Same thing with Baidu here. Yum China, we are also seeing a big decline from the top. JD.com. Weibo, and Sinopec. Again, these are all major Chinese corporations and they have all taken significant hits and over the last year or so have fallen dramatically from their all-time highs. Now, you and I both know that a drop from an all-time high by itself is utterly meaningless. You have to look at the valuation of the company. You have to look at macroeconomics. You have to take a look at the regulatory risks of the company or the country that that company is in. You have to take a top-down and a bottom-up approach to look at the company to recognize whether or not it has long-term growth potential. Just because it's fallen 50% from its all-time high, that's meaningless if it was 100 times too high to begin with. So what are the reasons why basically everything in China has been falling so severely over the last year or so? Well, one reason is because China has been cracking down on moral hazard and corruption for years now, and that has escalated within the last year. They started their aggressive approach to cracking down on corruption quite a few years ago, and by all their official reports, they've been very successful. They have put away, made people disappear, both private citizens and government officials who were contributing to corruption. And recently, their squeeze on moral hazard has increased as well, as evidenced by the massive real estate bubble collapse that has happened in China and the lack of effort by the central bank and by China to come in and try and bail that out. In fact, it looked like while that was all unfolding in the beginning, like the Chinese government was doing everything they could to put more of a squeeze on and to say, no, you've got to fail. We're not going to bail this out. Really a lot more of a capitalist approach to failure in their economy than we've seen by pretty much every Western nation over the last 2 years or so. Which brings up a good point because over the last 2 years, the entire world was extremely easy from a monetary policy standpoint. We saw the Federal Reserve and many central banks around the world bring interest rates down to zero, start QE infinity, printing a bunch of money to bail out their economies. Now, China wasn't absolutely tight. They still became more easy in the unfolding of the pandemic during 2020. However, they were not nearly as easy as the rest of the world, meaning relative to the rest of the world, they were much more tight. But that trend is starting to reverse as well, as this year during 2022, basically the entire world who has been easy for 2 years is now saying, hey, we need to get tighter. We need to raise rates. We need to start reducing the size of our balance sheet very soon here. Well, guess what? China is now basically doing the opposite. They just recently lowered interest rates for the first time in about 2 years. And they have a long way to go. They're nowhere near zero. Now, because of the unfolding of these regulatory risks and a lot of these companies falling in value, we've seen investors, very successful investors like Charlie Munger, double down and triple down on the best companies in China recently. In the first quarter last year, Charlie Munger almost doubled his stake in Alibaba, increased it by over 80%. And then later last year, in quarter 4 of 2021, almost doubled his stake again, increasing it by just about 99%. Now, Charlie Munger obviously has been around Warren Buffett for basically their entire careers, and they have very similar investing thought processes and investing styles. And one of the guidelines that both Warren Buffett and Charlie Munger use for investing is something Warren Buffett said: the best thing that happens to us is when a great company gets into temporary trouble. We want to buy them when they're on the operating table. Now, obviously, Alibaba has taken a hit, but investors like Charlie Munger look at this as a fantastic or a great company that is in temporary trouble and that eventually the market will realize should be priced much higher. And it's no secret that investors in China, whether it's real estate or stocks, have gotten absolutely hammered over the last year or so. But this is why successful investors say to buy when there's blood in the streets, even if it's your own. And there are some other recent things unfolding geopolitically right now that could also be bullish for China long term. One of the ways that they've been increasing ties around the world is developing business relationships and trade relationships with many countries, building their infrastructure for them in return for having access or rights to things like commodities. Commodities that are in tight supply all around the world, and over the last decade or so has allowed China to accumulate massive hordes of commodities. This is definitely helping the internal burden of prices rising around the world as they have massive emergency stores of a lot of necessary commodities. And the last thing that China has done very well at over the last decade or even longer is it's used its relationship around the world to invest in things that are going to pay dividends long term. So we always look at the relationship between the United States and China. China's the biggest, by far, biggest exporter in the world. And what they do is they send real goods to the rest of the world. And like the United States, we send back what? Paper dollars, worthless currency, right? So a lot of people look at that and say that China's getting the short end of the stick because they're sending out real goods and they're getting back worthless paper in return. But you have to look at the full story, because what is China doing with those dollars? They're investing them, and they're buying up rare earth mines all around the world. They're investing in rare earth mines in their own country. The United States, on the other hand, is sending out paper, getting consumable goods that are going into our dumps and that we have to continue to buy. We're not investing, we're spending. They're loving this arrangement because they're getting dollars and they're turning around and spending those dollars on things that will pay dividends and produce real goods for them, investments, assets for themselves that will produce for a very long time. And look, I totally get it. It's totally realistic to look at this and say, hey, I understand that China's selling might be close to done considering how long and severe this bear market has been for China. It's also possible to look at what's going on with commodities right now and say, hey, look, I really understand what's going on with commodities right now. There's a super cycle right now with commodities, massive bull market, and by everything going on in the world, it doesn't look like it's slowing down anytime soon, especially looking at rare earth minerals, looking at things like lithium and other elements that are vital to creating the technology that is going into so many new pushes, regulatory pushes all around the world. Looking at that and saying, I still am a little bit fearful of putting money into an environment, into an economy, into a country like China, simply because you never know what's going to happen next. Is their command and control going to get locked down and cause more problems? Are they going to have a further crackdown? Are they going to pull back on some of this easy money that they just started? We just don't know. So it's very possible to look at all this and say, I like where some of this is going. I'd like to shift it a little bit and get some exposure, but not directly inside of China. And one of these commodities that China is heavily interested in is lithium. Most countries around the world are interested in lithium simply because it is the vital ingredient to be able to make the green push that many countries around the world are wanting to make and causing regulations to go into effect that are saying, hey, we have to go green, we have to go battery, we have to go electric. Lithium is vital to that, and that is where the sponsor of this video comes in today, Lithium Chile. Lithium Chile is a company that fits right in between the recognition of the state of the world today and allegiances and ties, international ties around the world, investing in rare earth minerals and commodities, but maybe also still being kind of fearful of the regulatory environment and the bear market that's going on all around China right now. Now, again, a disclosure, this is not a recommendation, this is not financial advice, do your own research. But as you can see from this chart, which shows the projected growth in demand from lithium-ion batteries over the coming years, we are very likely to see massive increased demand for lithium, which obviously is necessary to produce lithium-ion batteries. Not only are these batteries used in electric vehicles, which are likely going to increasingly become a much larger part of the vehicle fleets of many countries around the world trying to make a green push, but it's it's also necessary in making the batteries for things like cell phones and laptops and tablets, and increasingly so to make giant battery infrastructure for electric grids that are getting their electricity from solar and wind, which are obviously unpredictable, so you have to store that energy somehow, and many grids are starting to look into upgrading to giant battery storage for their electric needs. Now, it's no secret that over the last few years, commodity prices have been on the rise, and lithium has been a part of that as well. And many signs point to the growth in the price of lithium continuing. Now, most people aren't aware, but many people consider the best place on Earth to get lithium is the Lithium Triangle. You can see on this map it highlights the Lithium Triangle around the borders of Argentina, Bolivia, and Chile. Massive concentrated amounts of lithium have been found in that area. This area is rich in lithium reserves. So rich that geologists say it may hold up to 54% of all of the world's lithium reserves. Now, the nice thing about this being located in Chile is because the production cost compared to Argentina, it's about 50% lower. The government in Chile is consistent, it's stable, and it's supportive of lithium mining. Take a look at this fact sheet with me. Number one, lithium prices are rising rapidly, and it doesn't look like there are any opposing forces to that anytime in the near future. Number two, Lithium Chile has 13 properties. Number three, there are low production costs in Chile due to exploring in brines. Number four, the jurisdiction is very predictable and favorable to mining lithium. Chile is number 8 out of 76 globally. Number five, the management team already has a track record in Chile. If we take a quick look at their financials, we can see that they've got a $90 million market cap, relatively small here. About 138 million shares outstanding, with warrants and options included. The fully diluted number is 158 million. Now, obviously, this is a very cheap stock, and at least one analyst has a price target of $1.50 or more, which is about double where it's trading right now. Now, one of the reasons for this projection is due to the comparisons to the peers and competitors in the area, like BYD and Mineras del Norte, who have recently paid just for rights with no guarantees, just the rights if they find any lithium. Meanwhile, Lithium Chile is sitting on an existing resource of over 1.4 metric tons. Further than that, Lithium Chile owns the mineral rights on all of their properties, so they have the potential to lease lithium producer for royalty payments. And finally, insider ownership in this company is 43%, showing there's at least some skin in the game and the people involved believe enough in the company to invest in it themselves. Altogether, given what is going on in the world right now, like I mentioned earlier, with commodities and materials and minerals like lithium, especially given the regulatory push all around the world to increase green energy, green tech, green things like solar panels, and converting that energy and storing it through batteries, and then using those batteries in things like electric vehicles and smartphones, tablets, laptops, all of that. It looks like Lithium Chile could be an opportunity to buy a company at a discount compared to what the market will value it at in the future, given everything they have in the ground that the world may soon need and want. Full disclosure, I do not own any Lithium Chile myself. I am not a shareholder. To succeed at investing, you have to both bet against the consensus and be right, which is very hard to do. There are always huge risks in investing in any company. You could lose everything you invest, it could go to zero, and you could lose more than you invest if you use leverage. This is not advice, not an investment recommendation. Do your own research, and if you're interested in more information on this company, I've got links in the description below. As always, I really appreciate you guys. Thank you so much for watching. Have a great day.